Hi, everybody. Let's take a look at our T accounts. Uh, Aptly named, aren't they? Remember that we've got six kinds of accounts that we're going to be dealing with in accounting. And it doesn't matter how small or how big your business is, you're just going to be dealing with these same six types of accounts. So let's take a look at the accounts first. We've got assets, liabilities, equity, withdrawals, revenues, and expenses. Remember assets, what you own, what the business owns, furniture, equipment, land, whatever you own is an asset. What you still owe on those assets is a liability. You might have accounts payable, you might have a mortgage, you might have a note payable on a vehicle. What you owe is a liability. Equity is what's yours. After you've How much investment do you have in those assets after you've paid off your liabilities? That's yours and that's your equity. Remember, the withdrawals are money that the owners take out of the business. If you're unincorporated, we call that drawing, that the owner takes money out. Same thing, it's withdrawals if you're a partnership. The partners want their money too, and you take out withdrawals. If you're incorporated, uh, the payments to the owners are called dividends, and they're paid especially a larger corporation, paid on a regular basis, normally quarterly, to the stockholders of the corporation. Also, we have revenues. That's our sales. That's the money we've earned from doing what we do, whether we're selling a product or selling a service. Revenues, the income that's coming in from us performing our service. Expenses, those are the costs to earn the revenues. If we've got a product, it's the cost of the product. We also have some period costs, rent, salaries, utilities. All those costs incurred to earn the revenues are called expenses. So those are going to be the six kinds of accounts that we're going to be dealing with in accounting. Please note that in accounting, debit, abbreviated DR, just means left-hand side. Credit, abbreviated CR, just means it's on the right-hand side. And remember that our debits and our credits have to balance. In accounting equations like that algebraic equation, remember in algebra, the left-hand side had to balance the right-hand side. Same here in accounting. And so we see the assets equal the liabilities plus the equity. And how's it changed? Minus the withdrawals, plus the revenues, minus the expenses. All right. Quickly, let's look at what increases or decreases an account. Okay. I've had people tell me, well, a credit's a automatic decrease and a debit's an automatic increase. No, it depends on the kind of account that it is, whether a debit or credit is a plus or a minus, is an increase or a decrease. For assets, this is where he started. The old monk in the Middle Ages that came up with double entry bookkeeping. Assets, debit on the left, increase on the left, credit on the right. Okay, it's a decrease. So debits left is an increase, credits are a decrease. And remember that each one of these accounts are going to keep whatever is a positive balance for them. So assets should always have a debit balance. If they don't, you got a problem. Liabilities should always have a credit balance. If you don't, you got a problem. Equity should always have a credit balance. If you don't, you have a problem, and so on. So once you've got that down on assets, that a increase is on the left, a debit, and a decrease is on the right, a credit, you've got it made. Because remember, this fundamental accounting equation has to stay in balance. And the way it does is that the liabilities and equity, these two are a mirror image of the assets. So if the debit on the left-hand side of the equation increases with the debit, that means the liabilities and equity increase with a credit. Why? The left-hand side's got to equal the right-hand side. Then that'll help you remember about liabilities and equity. And then remember these other three accounts, they change according to how they affect equity. Okay. Let's say, I hope you make some money. Let's say you get a check for $50,000. That's income. Okay. What happens? Your equity goes up. I don't know about you, $50,000 would do a lot for my equity. So revenues and equity track the same way. So an increase in equity in a credit, guess what? So an increase in revenues is going to be a credit. So as revenues increase, equity increases. Okay. Withdrawals and expenses are just the opposite. Increases are debits. That's taking money out of the business, whether you're spending money to expenses to earn those revenues as you are in expenses, or whether you're making a withdrawal and just taking money out of the business. Those are debits. Increases in expenses, increases in withdrawals are debits, and they're eventually going to get closed into equity, which is going a debit, and that's going to reduce your equity from the money that you've taken out. Anyway, this is a quick look at T accounts, and I hope it helps.